You've applied for 30 jobs, maybe more. You're qualified, you've updated your resume, still no response. Meanwhile, your rent just went up again, groceries cost more, you're doing all the right things, and it still feels like you're falling behind. Now, the job numbers are starting to match what we've been feeling for months. Let's break down what's actually happening and how it could impact Calgary's housing market. This is one of the most important updates we've done in months, and it's not because of prices, but because of people. Canada lost 66,000 jobs in August. That's a 0.3% drop in total employment and the largest monthly decline in over a year. The unemployment rate jumped to 7.1%, the highest it's been since early 2022. The damage was concentrated in that 25 to 54 age group, the core of the workforce. That group saw a net decline of 93,000 jobs, 58,000 men, 35,000 women. These are all full-time positions, not seasonal or student jobs. The private sector led the decline. Professional services, transportation, and manufacturing were hit the hardest. Construction was the only major sector that added jobs, up 17,000. But it wasn't enough to offset the broader losses, and a late summer construction bump is typical, but it doesn't change the trend. The labor force participation rate ticked down, which means more people are stopping their job search entirely. They're no longer even counted in the unemployment stats. They've given up. And they're invisible in the data unless you look a little deeper. This kind of drop is a sign of discouragement, and it's dangerous because it makes the job market look healthier than it is. Average hours worked declined. This means even those who still have jobs, earnings are falling. Less overtime, shorter shifts, fewer projects. Wages did increase 4.9% year over year, but that is still not keeping pace with inflation. The average Canadian household feels poorer today than they did last year, and the wage bump doesn't cover the gap in housing, groceries, or gas. Alberta lost 14,000 jobs in August. The provincial unemployment rate is now at 8.4%, the worst since 2017, outside of the pandemic period. Youth unemployment is in double digits. That's not just students. It's early career workers, retail staff, service industry jobs. We're seeing job losses in retail, logistics, admin support, and entry-level professional services. These aren't just low-skilled jobs. They're foundational parts of the economy that have supported many households. Oil and gas still holding, but hiring has slowed. Freezes are in place. No big layoffs yet, but the caution is obvious. Here in Calgary, job postings remain high, but they're not being filled. Time to hire is getting longer. If you're applying, you're likely hearing nothing or being offered short-term contracts instead of permanent roles. This is a soft job market. Employers are hedging, hiring managers are cautious. The growth from earlier in the year is gone. I've got friends struggling to get callbacks. Even older, very well-qualified individuals aren't hearing anything back. Headline jobs data can swing wildly month to month, but the survey of employment payrolls and hours, so SEPH, shows a slower, clearer picture, and it's been flashing red since Q1. Private sector job growth has been negative for months, the first time we've seen that outside of the recession in 25 years. Job vacancies are down, EI claims are up, long-term unemployment is rising. Discouraged workers, those who've stopped even trying, decreased by 23,000 in just 2 months. And here's the kicker. If participation hadn't dropped, the unemployment rate would be closer to 7.3%. So, as I said, right now it looks lower only because fewer people are looking. The Bank of Canada cut its policy rate on September 17th by 25 basis points, bringing it down to 2.5%, the lowest we've seen in 3 years. That's helpful for some mortgage holders. Variable rates will shift slightly down, and fixed rates are likely to follow if bond yields continue to ease. But, and this is important, this doesn't suddenly mean homes are more affordable. The spread between fixed and variable is narrow. Lenders are still cautious unless your income, job stability, and credit score are rock solid. You're not gaining much extra borrowing power yet. I know a lot of you are wondering what comes next. I'll have a full video coming soon breaking down where I think the Bank of Canada is headed next and what that could mean for home buyers next year. Canada now has over 2 million temporary residents. That includes temporary foreign workers, post-grad workers, and international students. Most are working in lower wage sectors: construction, logistics, food services, healthcare support, jobs that Canadians have historically done too, but now are increasingly hard for us to get. The temporary foreign worker program is under scrutiny. BC Premier David Eby has called for reform. Pierre Poilievre has criticized its scale and oversight. Some argue the program suppresses wages or discourages business from hiring locally. But here's what I want to say, and this is important. This is not a race issue. From my perspective, this isn't about blaming people who came here. It's about the system. These workers and students came here because Canada invited them. They followed the rules, they were told there was opportunity, and that promise isn't being fulfilled. They're not the problem. The system design is. We need a functioning immigration system because for decades, Canada had one of the best. We can't afford to just throw it away. Yes, some parts may need to be paused or reset, but we shouldn't forget contributions of immigrants who are valued members of our economy and society. There are pieces of the temporary foreign worker program that are essential, like agriculture, but we can't just shut the tap off completely. Maybe it's time to tighten temporarily until the labor market stabilizes. Switching gears, Calgary real estate is still holding its ground on price, but market activity is cooling. We're seeing inventory gains across the board, but more so in the higher density stuff like apartments and row homes. Detached homes are still tight, especially under $700,000, but that pressure is easing, and of course it depends on community. If you want the full monthly breakdown, I've got a separate video on that. Feel free to check it out. But here's what I really want to say. Even with an interest rate decrease, buyers are not going to rush back into the market if the job market isn't stable. If you hear a real estate agent saying, buy now, before the rush, it's bullshit. Don't listen to that. Only buy if it makes sense for you and your situation. And if you're buying a primary residence. Not because someone tried to give you that fear of missing out. I had plans to buy an investment property this fall. First it was summer, then it was fall, and I've hit pause. And it's not because I don't believe in real estate. Of course I do. Long term, it's still a strong investment. Just like the stock market is, some people park their money in stocks, some in real estate. I do both. That's fine. I'm not here to convince you one way or the other. Invest in what makes sense for you. But real estate as a primary residence, that's a different conversation. Not everyone believes in that either. I personally do. This video isn't about that debate. Although I do have a full rent versus buy breakdown if that's the rabbit hole you're in. So just remember, those numbers can change constantly. This is not investment advice. Run your own math, connect with a good mortgage broker, and figure out what works for you. Looking ahead, October and November are big. October 11th is the next labor force survey. If job losses continue, pressure ramps up for government action. October 29th is the Bank of Canada rate announcement and monetary policy report. November, 2nd, is the federal budget. So let's see how the government plans to address deficits, housing, and employment. And in the housing market, here's what I think. We'll probably see, of course, we'll see more listings in Q4. I think we've already hit the peak for inventory this year, so I expect those numbers to start to decline as we head into the holiday months. October usually brings fewer listings, but more sales than September. It's actually one of the better times to sell if your goal is to move before Christmas, but buyers right now are cautious. They are holding back, and honestly, I get it. A lot of people are saying, why would I buy now when prices will probably be lower next year? And honestly, fair point. Let's look at it this way. So if you're renting and trying to decide, do I buy now or wait, run your numbers and consider the type of property you're renting and the property you're buying. If you're renting an apartment and thinking about buying another apartment, I'd say, like pump the brakes. That segment's getting soft. I've had conversations lately with buyers who wanted to purchase a row home and sell it a year later. And I had to tell them like straight up, this is not the market for that. You'll lose money in a year, like if you're just holding short term. Builders are pulling back, pre-sale activity is slowing. This is the kind of market where builders suddenly love realtors again. Will rental demand stay high with so many non-permanent residents and students? That's the question. Vacancy rates have climbed. I'll have a full rental market update video coming out soon, so keep an eye out for that. What we're watching closely now is whether the federal government makes any significant changes to the temporary foreign worker program. The labor market is softening, real estate is adjusting, interest rates are softening as well, slowly. None of this happens in isolation. Of course, I hate to always be negative and the sky is falling. Canada is in a tough spot right now and it's important to be realistic. But there will always be bright spots and positive things to look for, so keep your chin up. I hope this helped. Thanks for watching and I'll see you soon.